Welcome back, everyone, to another deep dive.
From AI-inspired insights from farmers.
If you're enjoying what we're doing here, we'd love to hear from you too.
Absolutely.
Hit that like button, subscribe to the channel, and definitely leave a comment telling us what you want to see more of on this deep dive.
We're always looking for new ideas, and we really value your feedback.
So what farm-related mysteries are you dying to uncover?
Right.
What questions are keeping you up at night? Let us know, and maybe we'll tackle them in a future deep dive. Welcome to the deep dive. Today we're navigating a seemingly unlikely intersection, the high-stakes world of Wall Street and, well, the foundational practice of agriculture.
That's right.
We're going to explore how financial activities ripple through farming and our entire food system. And understanding this is really critical, especially if you're thinking about maybe starting your own farm.
Absolutely. For this exploration, we've gathered, a set of insightful sources.
Okay.
We've got articles on AI and commodity trading, strategies for managing agricultural risks, particularly relevant in sub-Saharan Africa,
Right.
and also a comprehensive report looking at speculation within commodities markets.
So our objective today, it's pretty clear, distill the key ways finance influences agriculture.
Exactly. We'll look at the consequences for farmers, the real-world effects.
And also think about the potential shifts in global food security that these financial currents might be driving.
Yeah.
Okay, let's jump in. Let's start by looking at what some might call Wall Street's playbook in the commodity markets.
Well, at its core, a big part of this playbook is commodity speculation. And it's important, I think, to differentiate between two main forms here.
Okay.
First, there's commercial speculation. You can think of this as a kind of price insurance for those directly involved, the buyers and sellers of the actual physical stuff.
Right, so they can hedge against short-term price swings.
Precisely. It lets them manage that risk.
So for instance, a food processor, maybe they use it to lock in a price for their ingredients months ahead, protects them if prices shoot up.
Exactly. Or a farmer could use it the other way, to lock in a price for their harvest, guarding against a price drop after all that work.
That makes perfect sense, a risk management tool, basically. But then there's another type you mentioned.
Right. This is non-commercial speculation. Here, the main goal isn't really hedging a physical deal. It's more about profiting from betting on where commodity prices are going to go in the future.
So they're not actually growing the corn or buying the wheat necessarily.
Often not, no. These speculators might take long positions expecting prices to rise, or short positions betting they'll fall.
And a key instrument here seems to be futures contracts, is that right?
Indeed. A futures contract is basically a standard agreement to buy or sell a specific amount of a commodity, say a certain tonnage of wheat,
Okay.
at a set price on a specific future date. Originally, like we said, these were for hedging and also price discovery, helping figure out what a commodity might be worth down the line.
So they gave some predictability for people actually trading the physical goods.
They did.
But then the landscape changed, didn't it, with these things called commodity index funds. Can you explain those and their impact?
Yeah, I think of these like diversified investment baskets. They're essentially portfolios stuffed with futures contracts.
Okay.
And they track the overall price movements of a whole group of commodities. Could be ag products like corn and soybeans, but also energy, metals, you name it.
And they got popular.
Very popular. They attracted huge amounts of investment. Our report mentions that by July 2008, the money in these funds was around $317 billion.
Wow, $317 billion. That's a massive amount of capital.
It is.
And if these funds often bet long, as you said, expecting prices to go up, well, that sheer volume of money must put upward pressure on prices, right?
Yeah.
Maybe even more than actual supply and demand.
That's a really critical point, that volume can sometimes become a bigger driver of price changes than, how good the harvest was or how much people actually need to eat.
So for someone thinking about farming, the takeaway is financial capital itself can move your prices, maybe more than your own yield does sometimes.
Exactly. And this flood of non-commercial money has been linked to more price volatility in ag markets.
More ups and downs.
Big time. For example, the FAO, they noted that back in April 2008, corn price volatility was 30% higher and soybeans 40% higher than what you'd expect just from supply and demand fundamentals. And the National Grain and Feed Association also testified that this non-commercial speculation was, a factor in that volatility.
Which naturally leads to this whole debate about regulation, doesn't it?
It does.
On one side, you have industry folks worried about over-regulation. They argue it might, dry up the capital needed for legitimate hedging.
That's their main concern, yeah. that too much regulation could reduce market liquidity, making it harder for, say, that food processor or farmer to find someone to take the other side of their hedge.
Makes sense. But then on the other side, you have groups like UNCTAD calling for stricter rules. They want to curb what they call excessive speculation.
Right, arguing it destabilizes markets and hits developing countries hardest.
And in the U.S., we saw things like the proposed PUMP Act, the Prevent Unfair Manipulation of Prices Act, trying to address some of these concerns.
Yeah, that was an attempt to close loopholes that some felt allowed too much speculation.
Okay, there's another piece here. Over-the-counter, or OTC, derivative trade.
Ah, yes, OTC trades.
These are the private deals.
Yeah.
Right. Not on the public exchanges. Sounds less transparent.
That's the nature of them. They're direct agreements between two parties. Think of it, like you said, as a private bet rather than one on a public board.
And they're a big part of
It's
this.
potentially huge. Estimates suggest they could account for 85 to 90% of the non-commercial investment in commodities.
Whoa.
And the challenge is, because they're private, there's often less regulatory oversight. It's harder to track exactly how much speculation is happening and what its impact might be.
Okay, so we're seeing how Wall Street's playbook extends into agriculture through futures, index funds, these OTC trades. Let's talk about what we've called the hedge fund effect. Now, the sources might not explicitly say hedge fund all the time,
Right.
but it seems clear we're discussing the impact of these large institutional investors, hedge funds included, involved in that non-commercial speculation and those big index funds.
Exactly. When you have these major financial players deploying huge amounts of capital, often with those long strategies we talked about, their trading volume alone can significantly influence, maybe even skew, agricultural commodity markets.
So prices might get detached from the reality on the ground. Less about supply and demand, more about financial flows.
That's the concern, yes. It's like their financial weight creates its own momentum, almost regardless of harvest sizes or actual consumption.
And this volatility, these big price swings, they have knock-on effects.
Definitely. Our sources suggest this extreme volatility can make traditional hedging, that price insurance we discussed, too expensive or just ineffective for the commercial players who need it.
So farmers or agribusinesses trying to manage their risk find it harder.
Or much costlier, yeah. If prices are jumping wildly, the cost of that futures contract to protect yourself can become unaffordable.
And we saw a real-world example during the 2007-08 food price crisis, didn't we?
A stark one. The sources point to speculation as a major contributor to that extreme price volatility back then.
With huge impacts on farmers and consumers globally. It really shows how these financial market activities have tangible, real-world consequences.
Indeed. Which brings us right to the farmers, the ones on the front line dealing with this. How does this speculation-driven price volatility hit their operations, their livelihoods?
Well, for a farmer, especially maybe someone new, trying to plan, trying to get a loan, these unpredictable prices must create enormous uncertainty.
Absolutely.
How do you budget effectively? How do you decide what to plan if you can't predict the return? It's like trying to hit a constantly moving target.
Precisely. And these problems are often magnified for smallholder farmers, particularly in places like sub-Saharan Africa.
Why is that?
Well, accessing those formal risk tools we talked about, like commodity exchanges, often requires trading minimum amounts, volumes that smallholders just don't have.
Right, they're too small.
And the cost of some insurance products can also be way too high for them.
So they're often more exposed to these volatile markets. But the FAO report did mention some alternative tools, didn't it? Things that may be more accessible.
Yes, it did. Let's talk about warehouse receipt systems, for instance, WRS.
Okay, what are those?
Essentially, a WRS lets farmers store their harvest in a certified warehouse. They get a receipt, proof of ownership. This gives them flexibility. They don't have to sell immediately after harvest when prices are often low. They can wait, maybe sell later when prices are better.
And they can use the receipt for something else too.
Sometimes, yes. The receipt can potentially be used as collateral to get loans, which is often crucial.
That sounds really practical. A way to bridge that post-harvest period and get credit. But the report also flagged challenges, especially in sub-Saharan Africa.
It did. Things like unpredictable government interventions in markets, maybe setting price controls or releasing stocks unexpectedly. That undermines private storage.
I see.
And also a lack of supportive legal frameworks. Banks need to trust the system, trust the receipts as collateral, trust that contracts will be enforced. If that legal backing isn't strong, it hinders the system.
So we saw examples where government actions, maybe in Zambia, reduced the incentive for private storage. And weak laws stopped banks participating.
Correct. But there were successes too, right? Especially with export crops like coffee in Tanzania, Ethiopia.
Yes, those examples showed it can work well, especially where you have strong markets and well-organized farmer groups or cooperatives.
Makes sense. And there was mention of the warrantage system in Niger, a more community-level approach for inventory credit. Interesting model.
Okay, moving beyond storage. The report mentioned contract farming. How does that help manage risk?
Contract farming is basically a preseason agreement. A farmer agrees with, say, a processing company or an exporter.
Okay,
They agree on quantity, quality, price, delivery schedule for a specific crop before it's even planted.
so it guarantees a market and a price.
Potentially, yes, it can offer that security. Plus, often access to inputs, seeds, fertilizer, sometimes even credit up front.
Sounds good, but are there catches?
Well, the report stresses the need for a solid legal framework to ensure fair contracts, fair negotiations, and that both sides stick to the deal. Enforcement is key.
Got it. Then there are information systems. Market information systems, MIS, and early warning systems, EWS. How do they fit in?
These are all about reducing uncertainty through information. MIS provide data on prices, demand, supply, helping farmers decide when, where, maybe what price to sell at.
So better market knowledge.
Exactly. And EWS provide weather forecasts, warnings about hazards like droughts or floods, so farmers can try to take protective action.
But getting that info out effectively is a challenge. Data quality, covering all the different crops.
Huge challenges, yes, especially reaching remote areas. The report mentions Isoko using SMS and web platforms shows the potential, but also the hurdles in making the information timely and truly useful on the ground.
Right. Let's talk insurance. The report contrasted traditional crop insurance with newer index-based insurance. What's the difference there?
Okay, traditional insurance pays out based on your actual assessed losses on your farm. If hail damages your specific crop, an assessor comes out, figures the loss, you get a payout.
Sounds straightforward.
But it can be costly to administer all those individual assessments. Payouts can be slow. And there are issues like moral hazard, maybe not trying as hard if you know you're insured, and adverse selection, only high-risk farms signing up.
Okay, so problems there. What about index-based?
Index insurance tries to solve some of that. Payouts aren't based on your individual farm loss, but on an objective, pre-agreed index, like rainfall in your district falling below a certain level or average yields in the area dropping.
So no farm visits needed.
Generally not. That cuts admin costs, speeds payouts, reduces moral hazard, but adoption in Africa has been limited.
Why is that?
High initial costs sometimes relative to what farmers can afford. Lack of good long-term historical data like rainfall records needed to design accurate indexes. And a big one, basis risk.
Basis risk. What's that?
Basis risk is the chance that the index doesn't accurately reflect what happened on your specific farm.
Oh.
So maybe the rainfall index for the whole district says it was okay, so no payout. But your specific fields got hit by a localized storm and you suffered a big loss. You get nothing. That's basis risk.
I see. So it's a trade-off.
Yeah.
Lower cost and easier admin with index, but you might not get paid even if you lose crops.
That's the core trade-off, yes.
The report also mentioned government actions, like managing grain stocks or using trade policies. How effective are those?
Strategic grain reserves can help stabilize prices, particularly putting a floor under prices when they crash. They buy up grain, support the price.
Okay.
But they're often less effective at stopping prices from rocketing upwards. And managing them is tricky. You need good info, transparency. Experiences in places like Malawi show they can actually distort markets if not handled carefully.
Right. And trade policies. Tariffs, quotas, export bans.
Governments use those to try and manage domestic food supply and prices. But they can easily mess up global trade, hurt neighboring countries, so they need careful thought, ideally within a regional context.
Okay. And finally, the report touched on financial services and technology adoption. Crucial supporting elements.
Absolutely vital. Access to finance, microfinance, credit schemes helps farmers cope with shocks, invest in improvements, adopt new tech.
Right.
And technology itself, better seeds, better farming practices, even things like precision ag, has huge potential to boost productivity and reduce production risks.
But farmers might hesitate to adopt new tech.
Yeah, if prices are uncertain or government policies keep shifting, it makes farmers reluctant to make those big investments. It's clear that while farmers in developing countries often have informal ways to manage risk in their communities, those informal systems can break down during really big, widespread shocks.
This paints a really detailed, almost overwhelming picture of the risks farmers face, especially with these links to global finance. Let's pivot now to power dynamics in agritech. This connects to what we learned about AI and commodity trading.
It does, very directly. The rise of AI in trading is part of this broader agritech trend reshaping the whole sector.
So in trading specifically, AI is being used for what? Analyzing data faster.
Much faster. Real-time analysis of massive data sets, building complex predictive models, even automating trading decisions. The goal for the trading firms is boosting efficiency and managing their risks better.
So we're talking about things like AI algorithms executing trades in fractions of a second.
Exactly. AI-driven trading algorithms for speed and automation. Machine learning models that constantly learn from market data to refine trading strategies.
Wow.
And predictive analytics trying to forecast market trends using all sorts of data sources, weather, news, shipping info, you name it.
And AI helps manage all that data too.
Definitely. From gathering it, processing it, to delivering real-time insights. Plus, AI tools are being used for risk management on the trading side, assessing risks, running scenarios, helping with compliance, and even detecting fraud.
This must be changing things dramatically on the trading desks. Human traders working alongside AI.
That's the trend, yes, collaboration. But the skill set needed for human traders is shifting. They need to understand data analytics now, understand how the AI works, to use its insights effectively, and make the strategic calls.
So looking ahead, what do the sources see coming? More AI.
Continued advances, wider adoption, that's the expectation. It could potentially lead to more market transparency, maybe reduce the information gap between big players and smaller ones.
How so? Reducing information asymmetry. Does that mean smaller players might get insights previously only available to giant firms with huge research teams?
Well, it's certainly a possibility as AI tools perhaps become more accessible over time. And human roles will likely continue evolving towards more strategic oversight.
This is a compelling picture, maybe slightly concerning too, of how tech is reshaping not just farming itself, but the financial layer on top of it. Okay, for our exclusive bonus insight, putting all this together, the financial influence, the agri-tech advances, how might this reshape food security, especially for new farmers?
Well, what's really striking is how interconnected it all is. More financial influence, more investment in agritech. That could lead to more efficiency, maybe higher yields overall.
Yeah.
But it also brings more price volatility, new kinds of risks. And that hits new farmers hardest, the ones without lots of capital or deep expertise in navigating these complex markets.
So AI could offer great tools for forecasting, managing resources on the farm, but it could also widen the gap, right? The digital divide, create new dependencies on tech providers.
Precisely. And market integration being plugged into global markets offers chances for better prices, wider reach, but it also means more exposure to global price shocks, to financial activities happening miles away that you can't control or maybe even understand fully.
So we might see the sector getting more concentrated, larger tech-savvy farms being better able to cope, while smaller, newer ones struggle to compete.
That's a potential outcome, yes. A trend towards larger operations that can handle the financial complexity.
So for someone starting out in farming today, understanding these bigger financial and tech forces seems almost as important as knowing how to grow the crops.
It really does. They need to think strategically. How can I use the benefits of tech and market info while also protecting myself from the risks of speculation and these agri-tech power dynamics?
All while trying to build a sustainable, resilient farm that actually contributes to a better food system. It's a lot to juggle.
It is indeed. It really calls for a holistic approach, not just farming skills, but financial literacy, smart risk management, maybe even collaboration with other farmers to gain more leverage.
Well, this has been a truly illuminating deep dive, looking at finance, agriculture, technology. It's incredibly complex and evolving fast.
We've seen how financial markets really do influence farming, how agritech brings both opportunities and risks, and the constant challenges farmers face managing it all.
Understanding these dynamics is just essential, isn't it? For anyone involved in farming or even just interested in where our food comes from in its future.
Absolutely. The trends we've discussed today, they really have profound implications for everyone.
So we'd encourage you, our listener, to think about what this means for you. Maybe explore more about the role of regulation, about different tech adoption strategies, or alternative farming models focused on resilience.
And maybe a final thought to leave you with. As these sophisticated financial tools and powerful technologies get woven ever deeper into agriculture, how do we make sure they actually serve the long-term interests of farmers and contribute to a stable, fair food system for everybody?
A crucial question. Thank you for joining us for this deep dive. Until our next exploration. Hitting that like button and smash that subscribe.